Hi everybody, this is Alan Ellman, the Blue Collar Investor. Today I want to discuss the out-of-the-money strike price. Now this is the most popular of all the strike prices because it gives you an opportunity to make the most money with your covered call rights. However, the out-of-the-money strike has its advantages and disadvantages. And a discussion of those pros and cons is the purpose of this video. So first, let's discuss the definition. What is the out-of-the-money strike? Well, that's where the strike price, or the price that we agree to sell our shares for, is higher than the current market value of the stock. So if our stock is currently trading at $28 and we agree to sell the $30 strike, that strike is said to be out of the money. Now this is a bullish strategy, and we use this strategy when the overall market is very strong and lacks volatility. So if the market goes up 400 points one day, down 200 the next, up 300 the next, that is not the kind of market environment where I'd want to sell out of the money strikes. We also want our stock to be technically sound and those positive technicals on high volume. And we want that positive momentum to be continuous, not the result of a spike in price perhaps after an earnings report. And finally, we want to make sure that that stock is also in an industry that's performing at the top of all of the industries. I constructed a chart to show you the type of technicals that I'm looking for when I sell an out-of-the-money strike. On the top of the chart, you see the red arrow shows an uptrending 20-day exponential moving average. The blue arrow shows an uptrending 100-day EMA, and the short term has the price bars at or above the 20-day EMA. The MACD histogram, which are these blue bars in the middle of the chart where the green arrow is pointing, and that shows that the MACD histogram is above zero, or a bullish signal. Below that, within the orange circle, we have the stochastic oscillator, a momentum indicator, that has broken above the 20th percentile in early October and has been ascending higher. And all of these technicals have been on increasing volume, as you see from the purple arrow on the lower right hand of your screen. So all in all, a bullish chart pattern, which is the type of pattern we're looking for when we sell the out-of-the-money strike. So what are the advantages of the out-of-the-money strike? Well, the main advantage is you profit both from the option premium, and you have an opportunity to profit also from stock appreciation. In the example I gave before, the stock can go from 28 up to 30, and that's $2 more per share that you will collect. There's less chance of assignment, because if you're selling an out-of-the-money strike, there's less chance of that strike ending up in the money at the end of the option cycle. And finally, time decay works in our favor, since the option premium is 100% time value, no intrinsic value at all. As you approach expiration Friday, that time value will approach zero. Now, like everything else, there are some disadvantages to this strategy. First of all, you get the least amount of downside protection of your initial option profit. Actually, you get no protection of your option profit. When you sell an in-the-money strike, the intrinsic value protects the time value of that premium. If you have low risk tolerance, this may not be the strategy for you, because if your stock starts going down, your profit from the option premium will immediately start to erode, and then once you've gone through that, you're going to start to lose money. So it's more if you have a higher risk tolerance. Now also, the initial premium may be low. The at-the-money strike will give you the highest initial premium, and the out-of-the-money strike normally will give you the lower option premium. But once again, you do have an opportunity to increase those returns through increased share value. Now, the option premiums on out-of-the-money strikes have a low delta. What that means is that for every $1 change in the price of the stock, the price of the option will not change by that much. It'll change by maybe 30% or 40% of that $1, 30 or 40 cents. So if your stock value starts to decrease and you want to close your position, it'll be more expensive for you to close that position than had you sold an in-the-money strike, which has a higher delta. Now the calculations could be done on the Ellman Calculator. I like to use the multiple tab. And here's what that would look like. On the left side of this tab, in the blue shaded areas, you fill in the information you get from the options chain. The left column is just the ticker symbol of the stocks you're checking. The next column is the price of the stock per share, 76.16 for Deere, for example. And then the option premium you're going to generate by selling that out-of-the-money strike. $1.15 for Deere if you sell the out-of-the-money $80 strike. Once you've entered all that information, on the right side, you could see that the information is calculated for you. ROE is the initial return on the option, and you have upside potential if the stock goes from the current market value up to the strike price, how much more you can actually earn in that 1 month cycle. And as far as downside protection of the option premium, when you sell an out-of-the-money strike, there is none. You do have your total position protected or break even by the total amount of the option premium that you originally sold. So we take a look at the right side of the column here, and our objective is always 2 to 4% a month, and we see that 3 of them I highlighted in yellow meet that criteria, and we look at those, and then we look at the column next to it with the upside potential. So if we were picking just one of these stocks, we would say, well, the 3.2% is giving me only another possible 1.3%. Not bad, but maybe the others are better. The middle one, the 4.1%, gives you a whopping 6.3%. There you can get a total of 10.4% if everything works out well for you in that 1 month cycle. And the 3.9% has a 2.4% possible upside. So you can make your decisions based on how bullish you are on the market. Now, if you see a return of 4.1% with a possibility of another 6.3%, you kind of know that that's a volatile stock, and once again, you should have a fairly high risk tolerance for that and be prepared with exit strategies if the stock starts to decline. So to summarize, out-of-the-money strikes are a bullish strategy for those with a higher risk tolerance. We want to use it when the market tone is positive, as are the chart technicals. And be prepared for exit strategies as you would really in all scenarios in case the value of a stock starts to decline. For those of you interested in a free copy of the Ellman Calculator, email me at alan@thebluecollarinvestor.com and visit my website www.thebluecollarinvestor.com, where you could read my blog articles, a tremendous amount of information, all free. Visit the Blue Collar Investor store for more educational products, and you'll have an opportunity to join my mailing list where we'll send out notices of articles, videos, new products, seminars, discounts, and such. So I hope you enjoyed this video, found it useful. I look forward to hearing from you, wishing you all the best in investing. This is Alan Ellman, thanking you. Take care, everybody.